Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Thanks for being with us. Well, today we're talking about assessments and appraisals. Please welcome my next guest, Ron Neyhart. He's Director, Southeast Valuation and Advisory Services with CBRE, and he's only been there for 30 years. Ron, thanks for joining us today.
Thank you, Michael. I appreciate it.
And if you will, Ron, to get us started, tell us just briefly about the different types of appraisals, because you don't always need a full-blown appraisal maybe for certain issues, right?
Yeah, let me go back. They changed the regulations first of this year. Historically, there were typically three types. There was the self-contained report, which is the type of report that most lenders order. It explains a lot, has a lot of detail about every facet of the property. The next step down from that was a summary report, and that's what a lot of corporate users order because it didn't have as much content and was also not as expensive as a self-contained. And then the last one was the restricted report, which is basically just a letter of value. This year they changed it, and they did away with self-contained and summary, but left restricted. So now it's based on scope of work, and it's kind of confused the industry, both appraisers and clients, about what type of report they really need. So it's based on the actual scope of work now instead of a predefined report type.
So there's there's not two types or three types anymore. There's not even two types. It's just a million types.
In a way, yes. I mean, a lot of our lender clients still refer to it as a formerly known self-contained or formerly known summary, and then it's up to the appraiser to kind of figure out the exact format type that we provide our clients.
And what's the process today for a lender that is picking an appraiser for a commercial property that they're doing a loan on?
It depends on the lender type. For example, the commercial banks go through a automated bid system, so they just throw out RFPs to many appraisers, and it's all done electronically. There's no relationships for the most part anymore. Life companies, still relationships. The CMBS lenders, still relationships. But commercial banks, because of the regulations, have changed the way they've ordered reports.
Okay, and so for the banks, they're not doing that for convenience. They're doing that because they're regulated to do it that way now, right?
Yes.
Okay. And what kind of challenges is that placed on appraisals for banks? I'm sure that's caused a little bit of issues, so they don't know who they're getting and what their experience level is, right? It's more based on just price and timing.
For the most part, a lot of people define it now as a commodity, and I say, well, it's actually worse than a commodity because most commodities that everybody buys, before you make that buy decision, you know exactly who's making that commodity product. With appraisals, you don't, because it's typically a blind selection process based on only fee and time frame, so you don't know who's behind the curtain.
Wow.
So you might get a good one, you might get a bad one. It's very challenging now for appraisers and for borrowers and lenders too.
Yeah, that is a challenge, and where else do you pay for something and you don't know the quality and the experience of the person you're paying for? I mean, that's amazing.
Yeah, it's like going in a car dealership and buying a car, but you don't know what make, model, what color you're getting. It's very frustrating.
Yeah, that is. And one of the definitions, part of the definition of appraisal involves the word opinion, but appraisal is much more than an opinion. Tell us about that definition.
Well, in appraisals, it's the definition of market value, and it's the appraiser's job, appraiser's opinion, to estimate market value. What some appraisers get confused as is, in my opinion, the appraiser should reflect the market, not make the market. For example, if the market is currently paying 2 cap rates for every property around the country, well, we know that's not the norm, but it's the current market. So it's our job to reflect that for our clients, not make the market and say, no, it shouldn't be a 2, it should be an 8.
Right. So the valuation is a process that shouldn't change. It should be, it is what it is, right? But then that is the opinion of that appraiser.
Yeah, it's the opinion of the appraiser based on the facts and the data that the appraiser finds in the marketplace. but the definition of market value doesn't change.
Yeah. And what about comps and what comps can be used? I mean, one of the things that when we review appraisals, if we think they're high or they're low, or if we think they're right on, usually the first place we go is the comps and see what they used and how they adjustment. So it would seem like opinion is going to come into play there of which ones they're using.
Very much so, and that's why it's critical that the appraiser knows everything it is to know about that particular comparable, because it could change the appraiser's opinion of that comparable and the information. You could have a comparable and have 5 appraisers come up with different cap rates for that comparable, depending upon the level of information that they've researched or have access to.
Right. Yeah, and which cap rate and NOI are they using? Are they using the seller's NOI, the broker's NOI, the buyer's NOI? Right. I mean, the more you look into it, the more the things can change. Right.
Yeah, and that's why it's critical to have a appraiser that knows the marketplace and knows how that comparable was transacted.
Yeah. All right, well, stay with us. We'll have more on assessments and appraisals. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL. Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Glad you can be with us. Today we're talking about assessments and we're talking about appraisals. A big part of any business person should know about appraisals and how they work and the changes that have happened with appraisals in recent years. My guest is Ron Neyhart. He's with CBRE. And Ron, one of the things that people run into is they think their property may appraise for too low a number. They see the market moving. How can a property owner that's buying or selling their property or maybe refinancing their property help the property appraise for the most it possibly can?
Well, it's interesting. As appraisers, it's our job to reflect the accurate market value, whether that's high or low, but it's always nice to have conversations with the appraiser, whether you're the lender or the property owner, about particulars going on with the subject property. For example, it may be a recent lease that's about to expire or renew at a higher rate. There may be some up-to-date, accurate financial information with rent roll, or there may be something going on in the neighborhood that's not apparent from the appraiser when he goes out there. So anything that we can get from the owner or the lender about the property, the neighborhood, that would help.
Yeah, that's a good tip. And what about if an appraisal comes in and you're a property owner, or maybe you're a lender, or whoever you are in the situation, and the property appraises too low, and you just feel like it's too low? Is what tips do you have for someone in that situation?
Well, it depends. If the property owner gets a copy of the report, I would suggest reading it and finding out if there's any factual mistakes going on. And if there are, point that out to the lender, or go back to the lender with new information that you've obtained that may help the appraiser. So typically, when in situations like that, it might be a typo or a mistake that the appraiser made that might impact value, or it might be that he doesn't have access to the current information in the marketplace.
Okay, and what's the best process? The banks, as you've said, are regulated, and they don't have as much contact direct. So what's the best protocol there if I'm refinancing one of my commercial buildings and the appraisal comes in too low? How do I get to that appraiser if I'm getting a bank loan and get him that information the best way that he's going to look at it in the best light? And can he adjust that? Can he?
Well, you have to go back to your relationship manager at the bank, your loan officer who's working with you, and tell him this, and then he will probably go back to his credit department or appraisal department and have the appraiser take another look. The appraiser can't take another look at it if the borrower asks him to. It has to come from the bank's credit department. Okay,
and I guess in some cases, if you think it's low, you could pay for another appraisal if the bank and the regulators allow that.
It's entirely up to the bank.
Yeah.
If they don't trust the appraiser that they have, they're free to order another one.
Okay, and the situations where banks have prop loans that they think are may be in default, and they're getting appraisals for their regulators. Are they under the same guidelines? They can't pick the appraisers, and is that the same situation?
For the most part, it's based on the electronic bid situation. Some banks are different than others, but most use the electronic bid situation.
Okay. And I'd like to ask you about appraisals that involve land. For example, we're dealing with a situation now, it's about 340 acres, and the appraisal came in, and they didn't take into account of the end-use product. And in this case, this land is going to be residential homes. And so in the appraisal, they didn't cover anything about what these lots or homes would be worth, what these lots would be worth, and the development cost of the property. And most important, I think, in this situation, is to when it's viable to build out. This is already entitled for residential homes. So they didn't cover in the appraisal, well, is this viable in 1 year or 5 years? And of course, that's an opinion of that people may have different ideas about, but shouldn't a land appraisal that on a property that's entitled to be residential developed, have that included in it about the timing and the cost to understand the highest and best use value of the property?
Yes and no. Many times, if the appraiser has good data, what we'll do is do a discounted cash flow, which was a sellout of a property like that, where you start with the retail value of one lot, and then estimate the absorption, deduct the cost, and deduct the profit. Where a lot of appraisers make a mistake is they'll take that retail value of just one lot, multiply it by the total lots in the subdivision, and say that's market value. That's not accurate. On the flip side, now we're seeing more transactions where you have what's called bulk sales, where it might be a 100-lot subdivision that sells for a relatively market-oriented price that factors in the holding cost and the infrastructure cost. So appraisers can use both, and probably should use both, if the data's out there.
And then they also have to determine the timing, right, of when it's viable. But, we've seen in this downturn a couple of years back where some of these properties are appraised for zero. I mean, the banks came back and had an appraisal and said, well, it's worth nothing. And they're like, well, how could that be? Well, because your holding cost to hold this for the next 15 years, or they're going to eat up all the profits of developing it.
Yeah, you really have to do an adequate job of supply, demand, and market analysis to estimate when you think it's going to be viable. And that comes into the art and science of the appraisal process.
Yeah, I believe there's a lot of different opinions because we sell a lot of land, and and we'll have 10 different buyers that will tell us 10 different things about what those lots will really sell for and when that property is viable to be developed, right?
Yeah, land is probably the most challenging property type to appraise because of all the variables and the unknown variables that go on with land, such as zoning, entitlements, infrastructure cost. Very challenging, and that's why they pay us the big bucks to do it.
That's right.
Or at least they used to.
That's when you get paid the big bucks. That's true. And I tell brokers who are looking at different sectors to work in that land is the most involved sector you can get into. I'm Michael Bull. This is the Commercial Real Estate Show. Stay with us. We'll have more on appraisals in just a moment.
The Commercial Real Estate Show is brought to you in part by RealNex, providing a comprehensive suite of powerful commercial real estate tools at an incredibly low cost. Visit realnex.com. That's REALNEX.
Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. Today we're talking about appraisals. We have Ron Neyhart with us in the Studio One here in Atlanta. And Ron, one of the questions that people are having out there today is about cap rates. On some of these core institutional properties, cap rates have really compressed, especially in some of the major cities. How long is this going to last? Can these cap rates stay this low? What do you expect to see?
Good question, Michael. If I knew that, I'd probably be on your yacht right now instead of in the studio. But everybody expects them to go up with the rise in interest rates, but it hasn't happened. I think there's so much demand out there for core assets that I think it will still compress cap rates a little bit. Plus, if interest rates stay close to where they are, I don't see cap rates moving much from the current level, or they could go down. Cap rates are going down, fees are going down. My handicap hasn't gone down yet, but we need to change that this weekend. But I think it can be sustained for a little bit longer.
Yeah, maybe my yacht will go down. I don't. I don't have a yacht, listeners, but maybe one day, right? Well, so you talked about interest rates, and we had the Fed on the show recently. You said you guys had the Fed out of your office. What is the expectation of interest rates, and how much might they increase, and how might that impact cap rates for the next few years?
I think if the Fed starts or stops the easing, you'll start to see a slow rise in interest rates, and with that, cap rates will probably rise with that. However, it may not impact values at all because the property level fundamentals are increasing. We're seeing rent growth around the country for most asset classes. So even with a slight uptick in cap rates, your value still should be pretty solid because the property level fundamentals have been increasing.
Okay, and let's say that I'm buying a property today, and I'm paying a 5 cap rate, and I'm looking at a 5-year hold. I guess part of that valuation process is to look at that reversion cap rate. When I sell this property, what cap rate I'm going to get at that time? And I guess if interest rates are going to increase, and we're in a hot market now, and I'm paying 5, I guess that cap rate's got to be somewhat higher, right?
Yeah, it would typically be higher anyway. Even if rates stayed the same, most buyers anticipate or project a higher terminal rate than the going in, just because of the time value of money and the risk. You're holding a property for 5, 7, 10 years. There's greater risk out there that the uncertainty in the economy, much like long bonds, have a higher yield than short-term bonds.
I don't know. Everybody thinks when they own it, it's worth more. Hey, I paid 5 cap for it, and I own it, and I'm selling it, and I'm going to make it pretty. I should get a 4, right?
You might. It could happen, but most buyers would not be as successful as you might be, Michael. So.
That's right. So you are asked, right, in some of these appraisals and opinions, valuation of what a property is going to be worth at a future date, right?
Yes, many times we're involved in assignments that require the appraiser to estimate what's called a prospective market value. And that prospective market value could be for a proposed property that's under construction or a property that needs a lot of rehab and renovation that's not stabilized. So it might take, a year or 2 or 3 years for that property to, one, complete construction and then reach economic stabilization. So it's the appraiser's job to try to reflect a prospective value, which means you're taking a look at the income, expenses, and cap rates of that prospective date.
Yeah, and that's why you have the date of the appraisal and the date of what that valuation, right, that you're proposing. Well, Ron, thanks for joining us today. We appreciate you being in Studio One with us.
Thank you, Michael.
And we're glad you joined us on the radio and on the video and everywhere else today. And you join us next week. We'll talk about the office market. Until next week, be sure that you always lead, learn, and laugh. And join us for the Commercial Real Estate Show.
The Commercial Real Estate Show is brought to you by Bull Realty Commercial Brokerage, a great place to do business. Visit bullrealty.com. RealNex, a comprehensive suite of powerful commercial real estate tools at an incredibly low price. Visit realnex.com. That's RealNex. Sozo Web Hosting and Cloud Solutions. Secure, reliable, and worry-free. Visit sozo.com. That's SOZO.com. FIU, Florida International University. Earn your master's in real estate online in as little as 10 months. Visit FIUonline.com. And by France Media, providing exposure to the world of commercial real estate. Visit francemediainc.com. For more information on these great companies or for additional podcasts, videos, or blogs, visit CREshow.com.